All right. Hello, everyone. Thank you to those that are joining us live and then on demand as well. And yeah, just a reminder, this webinar is being recorded. And so if you do need to drop off at any point throughout the session, that's okay. A recording will be emailed to those of you that have registered, and then also we'll make it available on our website and via social media as well. I'll hand it over to our esteemed panelists, Ilja and Simon, in a second, but just a brief introduction. We're here to speak about, well, this is the first expert webinar that we're doing as InvestorHub. This follows some closed-door discussions that we've had in dinners over the last 12 months, and we thought, why not open it up and share for the benefit of the broader public. Today, we're going to be speaking about dual listing strategies, specifically for small and mid-cap companies. This is something that I've been asked about to an increasing extent over the last 12 months. It seems that there are more and more companies here in London that are considering a dual listing. There are already quite a few that have a dual listing, and that's why we've got Simon and Ilja here today to share their experience. My name is Alex Stella. I'm the Managing Director at InvestorHub. We work with over 200 public companies across Australia, the UK, and the US. About a third of our clients are dual listed, and so we get a great deal of exposure to those structures through that. And as I said before, it is something that we are increasingly having conversations about. So again, quick housekeeping. We're going to break this discussion into 4 sections. I'll hand over to the panelists for an introduction in a second. Then I want to talk a little bit about their dual listing structure and the strategy that they're taking at their respective companies. I then want to talk a little bit about how they're managing investor engagement and access across multiple jurisdictions, and then go back to their individual backgrounds, which are quite different, and talk a little bit about how their backgrounds have led to, have influenced how they're approaching investor relations, and more specifically, the dual listing structure. We'll then open it up to Q&A. We've already received some questions prior to the webinar, which is fantastic. And if throughout this conversation you do have any questions, there is a Q&A tab at the bottom of your screen, which you can submit to, and we will endeavor to get through as many as we can at the end of the session. And then to conclude, I'll hand back to our panelists and ask them to leave us with some key takeaways and final remarks. But to get started, I might firstly hand over to Simon to introduce himself.
Certainly. Thank you, Alex. So my name is Simon Wray. I am the head of investor relations for Air Astana. We are the largest airline in Central Asia. We've got a big market share in our home market of Kazakhstan, and we also connect all parts of Central Asia to the international markets which we serve, including the UK, Europe, Middle East, and also India and China and other parts of Asia. Air Astana IPO'd in the beginning of 2024, so a reasonably young company from a listing perspective, although been around since around about 2001. We can talk more about the listing structure, I think, in due course, but we're listed in our domestic markets in Kazakhstan, and also we have a GDR which trades on the LSE here in London. In terms of my background, I've arrived at investor relations from a reasonably unusual place. I spent exactly 25 years to the day as a sales trader for different investment banks. So what I lack in aviation experience, hopefully I make up for with experience in advising institutional investors and also navigating capital market issues, which is increasingly a focus for investor relations. And finally, I just want to thank Alex and InvestorHub for putting this together and the opportunity to participate in this discussion today. I think it's interesting when you say a third of your clients are dual listed, Alex. It's obviously a very prevalent part of the listing structure, and it's important that we have the conversations.
Fantastic. Thank you, Simon. What about yourself, Ilja?
Sure. Thank you, Alex, and thank you, Simon, for introducing yourself. Ilja Graulich, I've been in the investor relations game for close to 25 years. With an economics background, I landed as a journalist covering financial markets, and then started covering mining, and then had an opportunity to join a mining company. I think it is still the oldest listed mining company on the Johannesburg Stock Exchange. At that stage, it also had a listing in London. And when I joined the business, the excitement around ADRs into the United States think post-apartheid South Africa, a couple of years shortly thereafter. And there was a big drive to create ADRs into the United States. We listed on NASDAQ, and at one stage we had the biggest ADR program as measured by conversion of ordinaries to ADRs in the United States. So that's the program that I was running for this gold mining company. Then joined a couple of other companies on various stock exchanges. We had ASX listings. We listed a potash business in Congo. So I've played a lot of time in the sort of junior mining space, development space, from exploration right through to mine build. And I've been with Tharisa for the last 7 years. Again, it's a business that was started from exploration through to development and now been in production for over 15 years. We had an initial listing on the Johannesburg Stock Exchange, and then roughly 2 years later, we listed on the London Stock Exchange, and over 60% of our trade now takes place on the London market. Been very successful for us on the London market. And as we'll get into the conversation around listings, you'll realize that dual listings can happen rather easily because there's quite a lot of overlay of various stock exchanges encouraging dual listings. But as so often it is, the devil is in the detail, and you'll discover that there are slight nuances between various stock exchanges that one needs to be aware of. The shirt I'm wearing today, we're close to Christmas. We run a mining business. We have 4,000 employees. And we've gone away from silly season to calling safe season. So we are on safe season. So while we have safety as a core value every day, it is the season currently that we talk about, and our little safety logo is on the one side here. So you're seeing me in my Tuesday safety gear that we're running around with at the present moment. So thank you for the introduction. And Alex, thank you to you for inviting me onto this seminar. I think what you guys are doing is testament to the evolving investor relations and the evolving listings that companies have to deal with, and the new tools that come about and how we can utilize those smartly.
Oh, perfect. Thank you. Well, look, let's stick with you before going back to Simon. You started to talk about the dual list, the structure that you have at Tharisa. Could you speak a little bit more for someone that perhaps they're not yet dual listed or they have a different structure? Could you start by just explaining this concept of a GDR, and then maybe go into a little bit more how your register is split across both jurisdictions? So just a bit more detail on the structure.
Sure. In our case, we actually went for a main market listing that allows normal shares to be listed. There are some complexities in terms of transferring shares from the one market to the other, but you actually get an ordinary share rather than an ADR and a GDR. And the concept of an ADR and GDR was brought about to make it easier for investors to invest in a business. I would argue that over the last 20 years, consolidations of markets plus electronic nature means that actually accessing primary shares has become much easier. But let's take a step back. When ADRs and GDRs came alive, an ADR stands for an American Depository Receipt, and a GDR stands for a Global Depository Receipt. And basically, it mirrors an ordinary share on a market that the company is not listed at, thus allowing investors in those markets, so in an ADR form, American investors, they can go directly to the exchanges that they are more familiar with and buy what is equivalent of a mirror image of a share. So in our case, the previous gold mining company I was at, we had a primary listing on the Johannesburg Stock Exchange, an ADR in the US, and the ratio was 1-to-1. You get various ratios, and that's got to do with listing criteria of various stock exchanges, but really it is a mirror of a share. And the whole point is that the bank that administers the ADRs and GDRs is often stated as having a much easier way of switching between the ADRs and the GDRs. So if you buy ordinary shares, so if you buy an ADR in the United States, the bank administering the program has to ensure that an ordinary share is bought, then converted into an ADR, so that the shareholder in the United States, in this case, can buy this share. There is a little bit of a cost involved, but certainly from a process point of view, I would argue 2 decades ago, it was a hell of a lot easier doing that. There are some other nuances with regards to listing jurisdictions There are some nuances with regards to where your company is incorporated, and it sometimes just simply makes it easier to access a stock exchange rather than going through the front door and trying to list your ordinary shares in a market such as the United States and or London. But I think the important point here is that there's been a massive move by exchanges globally to try and consolidate their listing requirements, to overlap some of the rules and the regulations to make it easier for companies to list. And at the same time, the registrars in the background have obviously also changed their systems. I mean, everything is electronic these days. You can imagine 25 years ago, even 30 years ago, a lot of it is still paper-driven, where your depository banks had share certificates. These days, with electronic natures, we've discovered that you can actually move a stock from the Johannesburg Stock Exchange to the London Stock Exchange in less than 4 minutes, and that's a process that we're currently looking at with some of our registrars on that side. So technology has moved on, but it was simply a way for investors to access something very specifically.
And Simon, on your end, so Air Astana has 3 listings. Would you be able to talk through each of the 3? And then I'd be curious how your share registry is split, or your float is split between the 3, and whether you see more institutional or retail activity on each of the 3.
Yeah, of course. And actually, perhaps just following on from Ilja's point there, and it probably says a lot about how far I've come from a sort of sell side background into IR, but he's talking there about the benefit of GDRs and ADRs from an investor access perspective. I think the important thing to remember as well is, from a corporate perspective, it gives corporates a much better access, or broader access, to capital as well. So it's a two-way street, and it really helps from that perspective. And really, that's how we we entered into it at the point of the IPO, in terms of trying to find the right pools of capital for that. As I say, we have ordinaries which are listed on both exchanges in Kazakhstan. There are 2, which surprises some people, but it trades on both.
What's the difference between the 2 exchanges? Is one a venture exchange or how does it work?
No, there's just two different entities. There's CASE, and we have our ordinaries which trade there, and also the Astana International Exchange, the AIX, and we trade both the ordinaries and our GDRs are listed there as well. So that essentially there's local market hours and local access to the GDRs as an international product, even though it sits on one of the local exchanges. And separately, we've got the GDR listed, and only the GDR listed on the LSE. In terms of the shareholder register, a huge generalization here, but approximately, the vast majority of our international institutional holders hold us in GDR form in the LSE, whereas the ordinaries are retail and institutional holders domestically. There's a huge generalization, and there's some quite significant outliers within that, but that's generally how we split it out, and we try and approach it on that basis.
Yeah, I remember when we've spoken prior to this, you were sort of commenting on how active the retail market is in Kazakhstan. And of course, Air Astana is it's the flag carrier for the country. So there's a lot of brand recognition, and so that makes a lot of sense. But could you speak to, when you've been over there and witnessed this firsthand, just the extent of the retail ownership in Kazakhstan and how active that is?
Yeah, I think if you were to go to a results presentation in the UK, there would be a lot of grey suits, a lot of sell-side analysts, some broadsheet financial press type guys there. But you can imagine the demographic of that room for any quarterly results in the UK. When I pitched up to our Q2s in the summer, there was very, very little of that demographic, and the room was full of social media and finfluencers, with my profound apologies for using my least favorite word, but there's a lot of the sort of financial markets are and retail investors are supported by a pretty advanced social media environment there. We've got about 60,000 retail shareholders in Kazakhstan. There's about 7,000 employees at Air Astana, and most of them are shareholders and receive stock as part of the IPO. So there's a big, as you say, national interest in it. It's a brand which people are very familiar with domestically, less so internationally, but it's a big focus of people's attention. And certainly rolling up to our Q2 results, there were social media influencers walking around the whole time. Someone set up tripod with a proper television camera and started their own broadcast about 10 minutes into the CEO's address. So, culturally something which you just wouldn't see in the UK or you wouldn't expect. But it's something which certainly our management team who've been there for a very long time completely embrace. And I think they rightly embrace it because it serves quite a significant retail population in Kazakhstan.
So it'd be good to get your take on this. I was in New York a couple of weeks ago speaking on a panel, not dissimilar from this, but focused on UK companies entering the US and specifically taking on an OTC cross-listing or preparing to list on one of the primary markets there. And there were sort of three key bits of advice that came out as a pattern from the conversation. It'd be good to see whether this resonates with you guys. The first one was that in terms of localization, it was more important, at least in the US, to focus on not differentiating the content, but differentiating the method of execution. So for example, in the US, it is very much a marketing and sales culture, and there is an expectation of more momentum, more, how do I put this, punchier press releases, more frequency of communication. Whereas in the UK, if you read an RNS announcement for a whole range of reasons, that, to be blunt, they're quite boring documents. They're highly sanitized bits of compliance. And if you were to release that as it stands in the US, it would fall flat. So that was the first thing. The second one was that it is really important with multiple listings to have dedicated resourcing. And I suppose that you guys are a great example of that there were companies in the past that whenever they enter a new jurisdiction or take on a new exchange, they just find more advisors, which can work, but then you've got this great big band of people that you need to project manage, and that can become quite difficult. So the second thing was focusing on internal resourcing. And then the third one was on not neglecting your home listing. So, and this might be more specific to the US, but a lot of the American market makers would look at your primary listing and use that to base the liquidity they're providing. And so if you've got no liquidity in London, it's not a panacea to just go to the US and suddenly get more liquidity. They are going to be taking their lead from what's happening back home as well. Is there any of that that resonates with your experience in managing your respective listings? Feel free to just jump in.
Yeah, I'm happy to jump in there. Certainly in terms of the localization, I think there are, as we all know, things which you have to say and things you have to disclose. And it's important that you meet that criteria in terms of disclosure. I think what investor relations tries to do is make sure that's done correctly to protect from the downside. I think what investor relations should do is try to do the stuff on top, which is exactly as you say, Alex, trying to identify who your actual audience is for a particular in a particular market and make sure that you address them in the way which they should be addressed. And I think that's quite important to tailor it. And it's not that challenging because the material's all done. The hard yards are preparing the tedious statement. It's trying to figure out how you position that in different markets and to different investor types, which is probably important. With regard to a dedicated resource, it's you're talking our book. I think it's certainly something which I think is very important. Having boots on the ground in any markets where you perceive that you're going to have a decent investor presence, I think is very, very important to make sure not only that you understand the nature of what they're looking for, but you're also able to engage them regularly and face to face. So that's really, I think, really important. And in terms of not neglecting your home market, I think that the extension from that is to make sure that wherever you do have a market, that there's demand for it. And I think when you're looking at dual listings or triple listings or any other structures, particularly sort of OTC products into the US, I think you've got to be confident that there's demand for for the company there before you start doing that. There is a sort of sense that if you build it, they'll come. But I think if you've got no presence in the market and no awareness there, it's sometimes a sort of a folly to think that you can just create a listing there and that suddenly your liquidity will improve as a function of that.
It was that language exactly which I've used before. I call it the field of dreams problem, and it's not just relevant to dual listings, but in general in public markets. This view that you can just deliver great operational success and the share price will move commensurately just does not work in 2025. The build it and they will come. The field of dreams problem is very real in all respects. Anything to add on top of that, Ilja?
No, I think well done to the LA Dodgers talking about Field of Dreams, exciting World Series that they've just completed. But I think one of the roles of investor relations is to make sure that the market is fully informed about the business, and whether you excite the market by writing slightly more hyperbolic press releases, or whether you simply put the information out. First and foremost is that there is no misunderstanding in terms of your investment proposition and in terms of the information that is put out. And often, and we're going through a situation at the present moment where we've always said we're going to do X with the business. It was in our prospectus, and that X is now happening. And some people are saying, well, we didn't know about it. So, but it is pointing out to people what we have said this since listing, that this is what we're going to do as a business, so that if you're looking for long-term shareholders, that they're fully aware as to what's going on. So to keep the market informed, I think, is important. In the US, for example, you've got quarterly reporting if you've got a primary listing on the United States. So there is more disclosure, I would argue. I know that's something that President Trump is currently saying, well, do we need this? But there is good disclosure. In South Africa, mining companies traditionally have always reported at least quarterly production results, so you knew what your ton, your grade, and your output was, so you could more or less understand what the financials would look like. And that's obviously very nice to see in terms from an investor point of view, because you have some yardsticks. I would argue that an airline, for example, can publish on a quarterly basis, this is our occupancy rate in terms of seats, similar to hotels. And then if you run a business, let's say on a 20-25% margin, you can very quickly work backwards how well the business is doing. So there are good markers to put out there from that perspective. And build it and they will come. That's difficult, because what you can do is you can build something thinking that these are the investors that we're looking for. And once you start doing the research, you actually discover that you should be changing your register. And I'm not talking about just balancing out between retail and institutional, but that you are looking for different type of investors that you're looking for. So initially, when you're looking for capital as a mining company, you're quite happy to bring on board just whoever would like to take that risk that you're looking at from a business. Once you reach some kind of steady state, you would like a different type of shareholder who's going to hang around for a longer than a quarter to try and build your register from that perspective. And that then obviously drives the next level that you need to understand from a dual listing perspective is, does it mean because you've listed somewhere else and you are, for example, in an index in your home market, does this necessarily mean that you're going to an index in your secondary market? And there's a lot of nuances that you need to think about when moving into a different jurisdiction from a listing point of view, and how you can then attract certain type of investors. So just because I have a listing in the UK does not necessarily mean certain UK funds have to buy me. Because I'm not a UK company, they can actually exclude me from that. In South Africa, it's no different. If you come into South Africa as a foreign company, we have an index called the SWIX, where you are penalized in inverted commas for your foreign jurisdiction, because there is a drive to somehow look from a weighting towards look for South African companies versus foreign listed companies. So as I said, the nuances are interesting to look at. But as Simon pointed out, you need to work at talking to all your shareholders, whether it's a retail shareholder holding one share or whether it's your biggest institution. You do have to talk to them. And as I said right in the beginning, ensure that the market has all the information that you're looking for, and that the market has kept abreast of of everything and anything that is relevant to the business.
Well, let's double click on that investor mix point and get into some practical examples. So with discussions I've been a part of, there are usually two overarching reasons why companies choose to take on an additional listing. It's either liquidity or capital. Sure. To be very reductive about it, capital comes from institutional investors by and large. Liquidity comes from retail investors by and large. One of the perceived, or maybe it's a perceived difficulty, but one of the difficulties of entering a new market is that your brand is unknown. So Simon, you might be able to speak to this from Air Astana. In Kazakhstan, the flag carrier, there is a lot of comfort and safety and trust with it already. But then when you come to London, there's British Airways, Ryanair, there are airlines already that the public has a familiarity with. You're coming in from a different country with a new brand, and so you're starting from essentially a position of zero, and you've got to do that investor marketing up. How do you think about maybe if there's 2 or 3 points that really work for you when you're thinking about the retail, so from a liquidity side, and then maybe from the institutional, and then we'll go around and compare and contrast those. So maybe just on the retail side, how do you think about that with a dual listing?
Yeah, so because we have such a small number of retail shareholders in the UK, I don't think we've historically addressed that well enough. I don't think we do enough to try and support that. And in the short time I've been here, I've started to try and make some inroads into trying to break down a few of those particular walls. I say in Kazakhstan and in Central Asia as a whole, because there's a brand presence, there's a sort of familiarity with the organization, and therefore there's a much broader retail market there. At the point of the IPO, we did marketing everywhere, right? There was a investor outreach and education process which went across lots of different geographies, and actually it turns out that in some geographies there's not an obvious demand, there's not an obvious landing point, and we look periodically at sort of US access products, and what we've discovered is actually there's not a huge investor base looking at Air Astana in the US. We don't have flights into the US at the moment, so there's no sense that it's not a brand which people are familiar with. So it's not something which we feel at the moment we need to try and knock down any doors to try and create some access products for that, because there's not necessarily underlying demand. When we look at the sort of investor base in the UK, I think there's a huge opportunity for us here, because it is we have flights into the US. People are much geographically much closer to Central Asia, much more familiar with that. So we're trying to position ourselves in a way where we're actually at least be able to be accessible by some of those UK retail investors.
And then Ilja, on your end, across South Africa and here, let's start with retail, because that's what we're talking about with Simon. What are some things that you have found has worked well managing those relationships across both jurisdictions?
So the mining company I joined some over 20 years ago, I inherited a relatively large retail following out of the United States. Historically, gold mining companies were high dividend yield payers, which is something that appealed to retail investors. And I think, well, no doubt that the United States still has the biggest retail investor base out there. And it's changing. I mean, we've seen that we've seen Chinese retail investor coming. Japan also has big, and Europe always has big following, but the US has always been the biggest. So I inherited that, and I saw the opportunity from a technical point of view, and that retail does drive liquidity. There's no doubt about it, which then brings institutions on board who, in terms of the initial screening, go, okay, there is liquidity, I can get in and out. I think that's something to consider. The other side of the equation is that never underestimate who your retail shareholder is. I think when discussions that you and I have had in the past, there are retail shows for investors to attend to learn about looking after your retirement, looking about how do you go about investing, where people pay $2,500, $3,000 to attend these conferences, to listen to experts, and how do I invest? And that's a lot of money. So you want the right people there, and those people who invest have got a lot of investable capital to invest in the market. So I've always seen retail as a huge opportunity, and have driven that through the other companies that I've been involved in terms of finding the retail shareholder base. South Africa historically has been very low in retail, and there was never an opportunity outside of an investor analyst society where even trying to access a database, I'm talking 20, 25 years ago, to try and access a retail base was pretty much impossible. With the advent of technology, we've seen a large change in South Africa for retail investor base. One stockbroker has been at the forefront of driving this, and they now have they've gone in the last 12 years from 0 to 100 billion, nearly 100 billion assets under management driven by retail. And they then drive retail education, both how the stock market works, but retail education with regards to specific stocks. They've linked up with other partners who write, I think Simon used the word, and I can't describe now, the influencers. But there are really educated influencers out there who write investor letters out there that will collab with the stockbrokers and or online platforms to try for people to get access to management. And I think that's important. Is retail has always been neglected in terms of access to management. In the old shows, we had investor shows taking place. You hired a hotel room where investors could meet management. But through the advent of technology such as this, you are reaching a hell of a lot more people. And I'll be quite frank, having two teenage girls at home, they are so comfortable with technology that this is the way they communicate. So for them to see management, for them to hear about stories through a screen like this is nothing new, because that's how they communicate. They even communicate with their friends sitting on the couch next to one another through the screens rather than talking to one another. So the familiarity is massively important. Plus, also, it allows companies through, let's say, Air Astana, that as a jurisdiction in Kazakhstan, ours as a jurisdiction somewhere else, to access different markets through the use of technology. So it really is a bridge between that face-to-face interaction that one has with management as an investor and a company with investors on the other side. So retail has always been important to me. Institutions, a lot of them are index jockeys that will follow you. Some specialized institutions, I guess, in the mining space. But I've always driven retail, driven it hard. And we've got good retail following up. Just done the register, just arrived this morning in my inbox, and very, very good retail shareholding, both in South Africa and in the UK. So very excited to have retail shareholders on board.
And one thing I'd add to that as well, actually, if I may, is that actually, I think the less liquid your stock is, the more relevant it is to focus on retail investors as a investor group. And perhaps I'm playing to your hand, Alex, but it's, I think if you are a Vodafone, then you're going to have a lot of retail investors because you're a big brand that people are very familiar with. But actually, the further down the market cap spectrum you go, the more of an impact which an individual retail investor can have on the share price. So it's more important from an investor relations perspective, certainly, to target that as well.
Definitely. I mean, for smaller companies, certainly it's probably the core of liquidity. But even for Vodafone, you think about how Vodafone deals with their customers, right? If they had Air Astana as a customer of their network services, they would probably have a business development manager or account manager that worked with you one-to-one in the same way that you guys would speak one-to-one to an institutional investor. But they still have an offering for me as a retail customer of Vodafone. And I think it's the same it should be the same on the PLC side of their business. Whether it's a very small part of liquidity or a very large part of it, it's all part of the liquidity. And if you can have a solution for everything, you're going to be in a better position than if you're just putting all your eggs in one basket. And I think that sort of speaks to what Ilja is saying. You can now communicate, and it's also taken back to dual listing where we're across different time zones. You can communicate very effectively in a one-to-many way. If you record a short video of you talking through an announcement, that can be watched just as easily by someone in the UK as it can by someone in South Africa or Kazakhstan or the US. And if it's produced correctly, it will have much the same impact. And so I think with retail, my take would be, and I think this is what you're saying earlier, just moving to that one-to-many, highly scalable communication and leaning into it as much as possible. I don't think, you might disagree, but I don't think there's any such thing as over-communicating context. You obviously, you've got to be careful with how you release new information, but explaining what stuff means. I mean, the more you do of that, the better, I think. But on the institutional side, have you seen that for both of you? Has that been in speaking to new institutional investors? Has the dual listing structure been net positive, net negative, or net neutral? What sort of response do you get when you sit down with an institution and explain the structure?
I can go. What we tend to find is that people will be one or the other. I had a conversation yesterday where quite unusually the guy said, it was an institutional investor who said, I can buy either your GDRs or I can buy the locals the way they were set up. So that's fine. I can have either of those in my fund. But typically people are looking for one or the other. When we approach institutions sort of about that. There is a focus on trying to figure out what sort of bucket we can put them into. And from our perspective, if we approach an investor with a aviation background, then we're lining ourselves up against a selection of other aviation companies in their geography. It tends to be easier for us when we approach people from a frontiers market or an emerging market perspective, because we're then lining up against we're speaking to investors who are already comfortable with the geography and it's not necessarily a sector thing. So that's one of the sort of distinctions, I guess, when we look at it from that perspective.
Anything on your
I think in our discussions, it really doesn't make the top 10 questions that we get. I think the only technical aspect that the institutions look for is, are you taking away liquidity from one market to another market? And then the other technical aspect is, how fungible is the stock from one market to the next? So, we have a very good broker in South Africa who I think trades across 6-7 different exchanges. They're a real true broker in the sense of the word, no investment bank attached to it, no lending, nothing. It really is a trading business, and they trade across various markets. For them, as I said, for these guys, we are looking at this concept of moving the stock from London to Johannesburg in less than 4 minutes through the back office situation and through technology. So that's what we're looking at. So it doesn't really pop up. What is unique with us is the controlling family still owns roughly 45% of the stock. So the founders of the business are still very much in there. So you are dealing effectively only with 55% that is tradable. Let's put that out there. We then have two big institutions or core shareholders out of Asia that like the business, they like the commodities. So we have a smaller pool from a liquidity point of view. So we need to work hard at making that, let's say, 50% or slightly less than 50% work extra hard in terms of creating liquidity from that perspective. So that's the question come up. The irony is, as soon as somebody starts buying in the market, liquidity actually is created. And again, I've described that to modern technology where there's a lot more brokers on the screen where you can find stock that is available to trade. So from that perspective, doesn't really come up. I would argue that if we had to pick another 2-3 different listings, these questions would start coming up, because the question is, why do you want to go to another market? London has served us extremely well in terms of creating liquidity, finding new shareholders, and really bulking up our register and taking it from this level to the next level. That's what London has worked for us. We are a unique investment proposition in terms of the commodities that really weren't available in London. So it was a slightly different story that came to the market there. I would argue that we wouldn't go to another stock exchange. Interesting, just as an aside, in South Africa, we have a market called A2X, which is really just a trading platform. So they rely on the rules, for example, of the Johannesburg Stock Exchange and or other exchanges, but they create a different liquidity event. And their argument is that the margins between buy and sell in terms of the system that they have is much better. And you've seen a lot of volume move from the primary exchange in South Africa, from JSE, not in our case, I'm talking about other companies, to the A2X market, who just simply put buys and sellers together, which is essentially what you want. So you need to look at those sort of opportunities, and be interesting to see how that works in Air Astana's case, for example, between the two exchanges, if there really are two fully fledged exchanges, or whether one is simply a trading platform, and we've seen that. And the German market, incidentally, is very famous for creating this trading, where if there's enough interest in a stock, they will simply start trading you amongst themselves using an exchange, whether it's Stuttgart, Frankfurt, Berlin, those historical exchanges where stock was just traded between various parties.
This is not, as I understand it, this is not dissimilar from the OTC structure, where it's a cross-listing. And that's one of the, that's an interesting point. That is one of the benefits that the OTC puts forward, and I imagine A2X and the Frankfurt exchange as well, that because it is not a primary listing venue, if someone wants to trade shares on the OTC or the ATX or Frankfurt, the broker actually needs to go to the primary market and buy the shares. And so in doing it, you actually end up increasing liquidity on your primary market, or at least that's the theory.
Absolutely.
Okay, so before we get into questions, something that I was interested to hear about, maybe if we could get 2 or 3 from each of you, some of the practical day-to-day challenges that you face in your capacity as investor relations for a dual-listed company that someone watching this who represents a single-listed company might not experience. And so things like time zone or something that we haven't thought about. Maybe, Simon, some of the things that as you've gotten deeper into the role, you've realized are unique challenges for a dual-listed company.
So time zone is an obvious one. Kazakhstan is 4 hours ahead of us, and I was initially thinking if we release an RNS announcement at 7 o'clock in the morning in London, it'll be 11 o'clock in the morning in Kazakhstan. The market will be open, and how are we going to manage that release of information? As it turns out, they work very civilized hours in Kazakhstan, so they don't start until 11:30 in the morning. So actually, that solved my problem, and I was quite pleased with that until last week when the clocks changed, and now there's a 5-hour difference. So I now need to think of another way to navigate that when that problem arises. But that's.
I was just saying on the time zone part, how do you manage that internally? So you'd obviously have a team in Kazakhstan, a team here. Has it changed the way that you need to think about preparing information or executing IR actions, or not so much?
It's changed how early I get up in the morning. So the team and the management are all based in Asia. So I try and work early hours, and it's quite pleasant for me because I get to about this time in the day, and it gets quiet in terms of noise from Kazakhstan. We try and look at it as a positive, because actually we work sort of hand in glove as a team, and therefore from our perspective we've now got pre-market open in Asia right the way through to after the market's shut in Europe covered, and also therefore reach into other markets, time zones beyond that. So it gives us, from a investor relations perspective and management perspective, a broader reach in terms of our capacity to be able to access investors in a bigger time zone. So that's helpful, and that works. I guess the other thing which we touched on earlier on, I think Ilja mentioned about the sort of regulatory overlap. You're obviously operating in different jurisdictions. So you've got different reporting requirements in those jurisdictions. And I think that is one of the things which puts people off when they're looking at dual listings, and the concern about having to understand the legality of what they report. And, I can't speak universally. I'm interested in, Ilja, how you feel about this. But what we've found is actually the reporting requirements are actually quite consistent across the exchanges. They tend to mirror one another. So, for instance, our reporting requirements to the LSE are almost exactly the same as those to the Astana International Exchange. There's some additional reporting in CASE, but that's tends to be sort of technical factors which are in addition and not necessarily publicly reported. So once we've done the work associated with one reporting, it tends to be easy enough to be able to sort of duplicate that into the other markets and other listings. So it requires an understanding of it. It requires a good working relationship with the exchanges, and someone needs to have a sort of an eye on it. But in terms of actually being able to deliver it is not unreasonably challenging.
Yeah, I'd agree with that. You can overcome these. It really is the real devilly details that one needs to look at. So we are busy with a share buyback, and unfortunately there are some nuances between both exchanges that just simply don't link up on that perspective. So it's sort of like, okay, you got to be careful. So which market dominates, which VWAP do you use, what exchange rate do you use, because we have a primary listing here on the Johannesburg. So those are sort of nuances that can be quite challenging, but you can overcome those. You just got to sit down, think about it properly, and overcome those, and that's pretty doable. On the other hand, there's some cool stuff that London is used to that the South African market wasn't used to. And I use something simple like a wall cross call, where the London analysts, post-market close, the day before results, always through the compliance department have this thing called a wall cross, where we sit down with the analysts, talk through the numbers, and it just makes it easier for them to look at the numbers and then put out their research report the next morning, rather than a scramble at 5:30 in the morning, or whatever time the numbers come out, to try and put something together and possibly make mistakes. So that's not something that's usual in South Africa. I know that's not a rule, but it's from a regulatory point of view. But the South African analysts have really taken to it and said, well, this is pretty cool. The downside is now, with London being 2 hours behind Johannesburg, we're literally past dinner time here. But those are factors that one can take into account. So if you take the best practice from both markets, it can be really, really beneficial on both sides. Rules and regulations, as I said, there's been a massive consolidation in terms of trying to understand that. And the masterclass I was at last week with Deloitte, where they were looking at encouraging dual listings between, ironically, the London and Johannesburg Stock Exchange. They were explaining matters. It really is something that is quite doable on that side.
Ilya, if I may ask,
sure.
My sense is that regardless of the regulation in each jurisdiction, if you apply a degree of sort of moral upstanding behavior, you tend to cover off sort of 90% of that before you start. I mean, in terms of like your wall crossing instances and things like that, it's as long as you're behaving ethically in one market, the chances are you're going to be entirely covered in the other. And really, it's the other 10% is just the sort of technical differences between the two markets. Is that do you find that's the same in South Africa versus UK?
Absolutely. I think that's a consideration. And more importantly, is we are registered in Cyprus, and the financial statements that we have to put out there are most probably more comprehensive than the financial statements that we need to put out for the Johannesburg Stock Exchange on our annual reports. So you need to look at those. And as I said, if you marry the most important aspects, absolutely right. I think it's most probably 95. The buyback is really a nuance that one needs to consider. If I look at governance, for example, whether it's the King Code in South Africa, the Cadbury Code in the UK, there's such a massive overlap that it really is very doable. I fully agree.
Good.
I don't want to disrupt the flow of the conversation, but I just want to add, before we run up to time, if anyone does have any questions, feel free to submit those below via the Q&A tab. And in the absence of that, we actually do have some that were submitted beforehand. So perhaps we can start reeling through a few of those and then make sure we give you guys some time for some closing thoughts as well. So the first one, and I'm not sure who this is, perhaps this is best directed to Simon, but is just whether you've come up against any difficulties or experience managing different languages as it relates to investor materials or regulatory announcements. So I'm not sure at Air Astana, do you release in more than one language?
Yeah, so my Kazakh is poor. My Russian is Duolingo level 5, which I think probably tells you as much as you need to know. My English is actually pretty average. Scottish, fine. So in all of our sort of regulatory documents, we've got to produce them in Russian and Kazakh as well. In fact, our Q2 results.
How do you do that?
Because we did it in Astana, our Q&A for our Q2 results, the questions were asked in either Russian or Kazakh. They were translated into English and then the answers were live translated into 3 languages as well. So there's some challenges around that and some very impressive translators who can do that. So it is a challenge, but I think it's just again a bit like the previous point. It's just trying to understand what the criteria are, what things need to be published in every language, and how you do that.
And I imagine that just means you need to be more prepared from an IR perspective, because you might need to allow slightly more time. Say you draft an RNS in English, you then need to allow an extra X period of time for whatever the services you use to translate it to Kazakh and then Russian, and then make sure it all matches up and go from there. So is it just more planning, really?
Yeah, exactly. So I've got a board meeting in a couple of weeks' time. I've got a board report I had to submit tomorrow, but I had to really do it today because it needs to be translated into Russian for tomorrow. So it's just about trying to get things done ahead of time. But IR is really just a function of being one day ahead of what you need to, where you think you need to be, and you're all good.
Yeah. And Ilya, is Tharisa all in English, or?
Yeah, it's all in English. the nuances between English and South African English. I think even our analysts have gotten used to them by now. So the word "how's it" is well explained with the analysts in London, and then we have nuances. I'll see you just now. Anybody who doesn't speak South African English will get very confused, but they understand fully what that means. Being German native speaker, it's always worked well. Seeing obviously funds in those jurisdictions, but yeah, everything is in English. Even Cyprus is fully in English. We don't have to translate into any other language over there.
Yeah, fantastic. And then I'll get through one more question before I give you guys a chance to close, so we don't run out of time. But this question, so to speak, more of a personal one. So you both come from different IR backgrounds or different backgrounds before getting to IR. Has that shaped the way you approach it? And so maybe, I mean, Simon, we can start with you again, because you've come from, I suppose, more the other side of the market originally. Has that changed the way you've been thinking about IR in the role now?
Well, I think it's actually probably informed how I think about IR now. I don't really know what a traditional background is for IR, because everyone comes from such a different background, and it's one of the interesting things about the industry is that everyone has done something different before they got there. So everyone adds something, approaches in a different way, which is quite engaging for me. My sort of philosophy about IR is really two things. One is that IR should not just be a mouthpiece for the organization and explaining the story, although obviously that's a key part of it. But I think my time as a broker has taught me that actually what you get back from your clients or investors is enormously valuable. These are people who spend a huge amount of time looking at individual stocks, your peers, your markets, your geographies, macroeconomics, and therefore their input back into you as an IR officer is hugely valuable. And the process of feeding that back into the organization should be a key tenet of what you're trying to achieve from an IRO position. And the other thing, which is probably, I would imagine completely unpopular amongst IR professionals generally, is I feel that share price is actually quite a good barometer for the success of an investor relations program. And if you listen to podcasts and webinars with IROs, and they often get asked about what their KPIs should be and how they should be assessed. And before they get to the point where they answer the question, they come up with a very considered and articulate justification for why share price is not really necessarily anything to do with them, because of all the other exogenous factors which are influencing it. And my, as I say, slightly unpopular view is that actually if you have a good performing business and a bad performing share price, then the distinction between those two should be is a communication to the market issue. It's not always as simple as that, but I think it should certainly be an input into that. So all of that sort of philosophy tends to come from my background, spending a lot of time in markets and convincing myself really that share price is a reasonably good barometer for how the market at least perceives the company to be performing.
There you go. Well, I want to give two more rapid fire questions before we close up, and we'll go back to Ilja for this one. Sort of just around key takeaways. So if there is someone that's watching this on demand or on the call now, and they are considering a dual listing, or they've already got one, but they want to optimize the structure, what is the one or two most important things that you think they need to get right from an investor relations perspective?
So I think, first of all, obviously, coming to the market in the first place, in your home market, is a big step. I think the way capital is available these days around the world, still coming for listing is a significant step for businesses. And that certainly means that you've taken a significant large step to go to that listing and then used the home market to try and understand how investors behave. The world does have good capital, and depending what the business requires, those are really considerations to look at to say, okay, will moving to a different market assist what Simon just discussed, maybe a better understanding of our business model and change and closing that delta between what the business is actually worth and what the share price is, or vice versa, to try and understand that. I think I've hinted at there are small nuances that really need to be thought about. So there's a London company that always had a listing here. They had a listing in AIM. They've now gone for a primary listing on both markets, for example, when they moved up to the new primary exchange on the London Stock Exchange. So that's a consideration. We haven't done that yet. We still have what we consider a primary listing here and a secondary listing in London. But as I said, the opportunities for us have been that the London market has created that liquidity and brought on board a hell of a lot of new shareholders onto the register. So that's been really something to look at. So I think the nuances are important, and then don't underestimate that you do need to spend extra time communicating now in two markets. As much as you see the benefits, you need to think about that, and whether it's a time zone related, whether it's language nuances that you need to be related, whether it's regulatory that you need to think about. You need to speak to those two markets. Now, for me personally, I don't have a problem communicating to people. It's something that I've always enjoyed. Background as a journalist, working from a communication point of view, telling stories. I think that's something that I really do enjoy, and interacting with people, and then importantly, taking the information that they give me and translating that back into the corporate strategy for businesses. So that's something to consider. So it really is the technical aspects and time and as much as you addressed it earlier, whether you do this yourself, whether you hire somebody internally, whether you have an external party, it still takes that management time. And it's good sometimes to have an external party to bring on board, because again, you're flushing out little nuances, cultural nuances possibly, by learning about this new market. So take the best on board, but then bring it in-house to sort of drive the message development that is there once you understand it further. And then it's maintenance. I mean, I cannot underestimate or underemphasize how important that is in terms of maintenance that is out there. So yeah, you need to speak to your shareholders.
Fantastic. All great points. Thank you, Ilja. Simon, any advice for companies looking at undertaking a dual listing?
Yeah, I was going to say I can be brief, because I completely agree with everything you said there. I guess it comes down to two other things. One is why. Is there a natural second market for your stock? Don't just have a secondary listing because it sounds good or you think it might achieve something. Is there an investor base and a natural investor base for your industry, your product? Is there a familiarity? And have a think about that work before you go down the road. And the other thing, and to Ilja's point, is it's good to have some boots on the ground. It's good to have someone who's there responsible for it. And we're talking our own book here from an IR perspective, but it is a resource worth applying if you're going to have two different listings, to make sure you've got people servicing those from an IR perspective in those geographies.
Well, I think if I could offer one takeaway from listening to the two of you the last hour or so, I think do not rely on build it and they will come. All of what we've described is a great deal of work, and there is a great deal of benefit if you do the right work, but dual listing is certainly not this broad panacea for all of the for liquidity and capital issues. It requires the hard work, which both of you seem to be doing. Well, look, thank you to Ilja and Simon for joining us today. If you had a question that you didn't get a chance to ask, please send it through to myself, and I hope I'm not speaking out of turn here, both Ilja and Simon are very open people that like having conversations. Their credentials are readily available on LinkedIn or on their respective companies' websites. So I'm sure that, no, please jump in, guys, if you're not happy with this, but I'm sure they would love to speak to a peer about this and exchange ideas as well. So please reach out to them directly also. But anyway, thank you, Ilja. Thank you, Simon.
Thank you very much, Alex. Thank you.
Thank you.
Thanks, guys.